converted it to a rental property. After about a year and a half, tenant stopped paying. It took me 9 months to get rid of that tenant. They completely destroyed the house. I had to put in $40,000 from debt I didn't have to update the house because the place was completely destroyed, to then get it to a sellable position, to then sell it.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined by David Warren, and we're back. We're both level 2 mortgage agents. Dave is also the owner at Referral Mortgages. And we want to give a quick shout out to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and EasyNeonSigns.ca. Use the promo code TOREP and get 20% off each and every order. David, how you doing? Lots to cover today. I wanted to kind of lead off. We alluded to this last week. We kind of touched on it, but Canada avoided an election. Mark Carney's budget narrowly passed through the House. So last week, the minority government managed to get its budget approved by the slim margin of 170 to 168. So that avoided a snap federal election. Tension was high. Okay. Budget vote was treated as a confidence motion, meaning failure would have triggered an election. Everyone kind of knew this going into the vote last week. From a mortgage industry perspective, key takeaway is how political stability, even narrowly achieved, affects rate policy. So federal infrastructure spending, housing market expectations, etc. So what do you think, Dave? Like, we kind of knew this was happening. It was pretty much inevitable. I mean, I don't think anyone expected it not to go through when they announced it. But what's your takeaway from just kind of the overall sentiment, I guess, of everything that happened last week?
I think no matter what, I don't think any party really wanted it to not go through. I think it was posturing from the opposition parties of it, from the Bloc and the Conservatives, that of them not wanting it to go through. They opposed it and they didn't want it to go through, at least at like high level. But I don't think anyone wanted an election either to then create further instability. So yeah, I think it's, like you said, wasn't surprising that it passed through. But again, to be seen how things roll out and how this budget comes to fruition. Again, like we've seen from past budgets with all parties, budgets get released. What actually gets implemented or followed through on those budgets is a whole other story. So, time will tell on that side of things.
Yeah, and given the increased federal borrowing and infrastructure spending, do you expect mortgage lenders to anticipate upward pressure on long-term rates, or how do you think this will impact kind of the short-term and long-term bond market and rates in general?
I mean, I think it's going to impact both fixed and variable because, like we talked about in the last week about, and past episodes about this budget, that it is inflationary spending. We'll get into it next week, but it is being funded by the Bank of Canada buying Canadian debt, so weakening the strength of our dollar and just increasing that money supply. So it's going to cost, like, that's inflationary. Again, and we'll dive into that next week deeper. But really in it is, if it becomes inflationary spending, which then again drives up core inflation, that's going to impact what the Bank of Canada does on a go forward basis with the overnight lending rate as well, depending on the bond buyback program, whether, how that's going to impact the market. The release of additional CMB bonds for multi-residential, that's going to impact the bond market. So, there's a lot of impacts that this has. And it's not just, focused on one program. It's not focused on just, what they spend on military or what they spend on, an LNG pipeline, if they do, or whatever it may be. It's really in some of these other policies or economic impacts that it creates.
Yeah, I think that's one of the things that there's just so much noise now, right? Like, anytime, even if you try to stay in the know, finger on the pulse, there's so much noise that you can read a headline. Two people can read the same headline and have completely different opinions of the topic. It's like there's just so much information out there now and so much conflicting information that it's hard to really know like what impact this is going to have on the short and long term. Bill 60, that was something that we were talking about before we came on air here. You had some bullet points you wanted to touch on about that.
Yeah, so Bill 60 is
Maybe
a
summarize Bill 60 for anyone who doesn't know first, and then we
for
can
sure.
kind
So
of
this is a provincial change. So this is an omnibus bill that was passed yesterday by the Ontario Party, who is in power currently, and obviously holds a majority. So there wasn't much, ability from an argument standpoint. It relates to the Residential Tenancy Act from 2006. So it was titled as Fighting Delays, Building Faster Act for 2025. So kind of addressing a number of things within that Residential Tenancy Act that I think obviously impacts a lot of our listeners with regards to those that are landlords, those that are possible investors in property, and for realtors and mortgage agents, but more so in our listener base that obviously is a budding landlord or a current one. But eviction for landlords owned use, so the N12 notice, it's proposing removing the requirement for landlords to provide 1 month's rent compensation or an alternative unit when ending a tenancy for landlords owned use if an N12 notice is given, as long as they give 120 days notice. So if it's under 120 days, then they're providing that 1 month's compensation. So this would make it easier for landlords to reclaim units without prior financial obligation. Shorter notice or grace period for rent arrears. So an N4 notice for those that are landlords know this, basically currently, if a tenant is late and you issue them an N4 or a notice that they're late on their rent, which they then have 14 days to make that up before you can kind of go to the next step. But it's that date, that 14 days starts from when that N4 is issued, not from the late payment. So if you're not on time issuing it day one after if they miss the first of the month, issuing it on the second, your 14 days starts from there, shortening that up to 7 days for that pay arrear. And then introducing the possibility of defining persistent late payments via regulation. So again, for what happens with a lot of landlords and small landlords is that somebody is late on their payment. They have 14 days. If they make a partial payment, that's restarting the clock again, and they can persistently be late. And so this is kind of creating a defined regulation around that persistent late payment. And this means repeated late payments could be classified and lead to quicker evictions, limiting tenants' ability to raise new issues at arrears hearings. So it stipulates that a tenant will not be able to raise new health and safety or other issues at a rent arrears hearing unless they meet strict criteria. As an example, paying at least 50% of the alleged arrears in advance. This means in arrears proceedings, a tenant's ability to defend by raising new issues might be curtailed. So again, like going into a non-payment or arrears hearing, that they can't just start throwing out random stuff at that time if they haven't made any payments.
So health or safety issues would be what? Like something with the property itself?
Like mold, like mold,
Yeah,
or
right.
or a railing, or just coming up with something, and whether they're legitimate or not, not being able to not be 100% in arrears and then try throwing that out as a claim for why payment hasn't been made. And so saying that at least 50% of the arrears would need to be made in order to bring that up as an issue. Faster LTB decision review and fewer rehearings. So the period in which a party can request a review of a decision would be shortened from 30 days to 15. And it would give the government the power to regulate the grounds for review, potentially limiting when a rehearing is possible, limiting or restricting postponements or delays. So would allow regulations to specify when the landlord and tenant board must consider and cannot consider when deciding whether to delay an eviction order based on a tenant's personal circumstances. The aim is to reduce adjournment culture and backlog by tightening criteria for delaying hearings or evictions. And the general goal is of speeding up the process at the landlord and tenant board for landlords, especially small landlords, and unlocking the rental supply. So government explicitly states the changes are driven by a desire to reduce delays at the landlord and tenant board, encouraging landlords to put vacant units back into the rental supply market quickly. And really kind of the aim is to at easing the rental supply constraints. But I think that the changes most importantly are on both sides. I mean, the quicker that a tenant can be heard by the LTB, I think is important. The quicker a landlord can be heard by the landlord and tenant board is important. Especially for small landlords that they have one rental property, one rent, one tenant on it that's paying rent. And when they get behind, and sometimes it could take, 90, 120 days longer for eviction, people become people are already living paycheck to paycheck, and they're relying on that rental income to make that mortgage payment. Well, that arrear on that mortgage like falls on that individual, and that lasts with them for forever, really, and really tarnishes their ability to borrow again, raises the prospect of default, which then again affects them from a credit standpoint, but then also removes that property if they default on it. Like it's being removed from that rental market for a subset of renters that in a lot of cases, townhomes, single family homes are what small landlords own and that they rent out, and would remove those larger properties off the market when we have the smaller landlords going into default and not interested in even buying a rental property like a townhome or a single family, that because of the issues with the landlord and tenant board. So, really, like I said, important implications to watch from a landlord investor standpoint. Faster evictions timelines and lower compensation for own use may reduce the risk or improve cash flow turnover flexibility, but may also increase tenant turnover costs. From a tenant stability perspective, reduced protections, shorter timeframes to respond or raise issues may raise risk of sudden tenancy termination or eviction, which can affect overall rental dynamics. More frequent turnover in rental units, faster eviction process may influence assumptions around rental income. So there's the possibility from a mortgage perspective, but the really in it, I think, is like there's such a backlog with the landlord and tenant board. I think the objective with it is really just to speed up that turnover and not have those backlogs again, primarily for the smaller mom and pop investors. So obviously more to come with that. It just got passed. It was introduced a couple of weeks ago. It was not talked about too much or spoken about too much, but was passed through yesterday. So we'll see what Queen's Park kind of has to say about it and more details to come on it. But overall, kind of that's a high level summary with regards to the rental aspect. There's a lot of other stuff in it because it's an omnibus bill that covers a lot of different topics, but this is one aspect of it.
In hearing you speak about that, to me, the biggest thing they're trying to find is that like happy medium somewhere in the middle, because there's bad actors on both sides, right? There's landlords that are evicting people without cause, or they're forcing people out when they shouldn't be, or what have you. So you want obviously renters to be protected. Nobody wants to be, evicted from their home in 30 days with family and kids and whatever, But at the same time, there's really good landlords that are extremely respectful and take care of their properties and so on. And the actual tenants are taking advantage and so on. So you want them to have proper recourse to, be able to evict them if there is bad actors on that side. So I think that 30 to 15 days is really important, because I know just from hearing yourself and some of our other friends that have dealt with the landlord tenant board, it can be a nightmare. Like you're waiting months just to get in front of someone to explain what's happening. So, if you're talking someone who you need to evict, it's been 90 days, you're just getting in front of, a judge or whoever's making those decisions at the landlord tenant board, it needs to be cut. So I think there's somewhere in the middle that's a benefit for both sides. You just don't want one side to be able to take advantage or, over leverage their position on either side. So I think it seems like it's a step in the right direction to finding that comfortable middle ground, at least from what you've explained. But I know I've heard horror stories on both sides. So I think really just finding something that makes everyone happy, that's fair and equitable on both sides, is like what's most important. And this seems like it's a step in the right direction.
I'll give a real example of my own, and kind of that removal of a like ideal property for a family being removed from the rental market. 10 years ago, I converted my single family townhome, a freehold townhome, which was my first home. 10 years ago in Barhaven, I converted it to a rental property. After about a year and a half, tenant stopped paying. It took me 9 months to get rid of that tenant. They completely destroyed the house. I had to put in $40,000 from debt I didn't have to update the house. And I was so sick of dealing with that process that I did not want to deal with a tenant again on that property. And I sold that property. That removed a 3-bedroom, 2-bath home from the rental supply. Yes, it went to, I'm sure, a family bought it that then moved into it, but that moved an ideal property from the rental supply because of how long it took for non-payment. So 9 months of not paying, had to go into debt to cover that mortgage, had to then borrow more money for the renovations because the place was completely destroyed, every aspect of it, to then get it to a sellable position to then sell it. And so when you have such a long process through landlord and tenant board to get rid of non-paying tenants that you can't control even the condition they leave your property in, because you can't even go after them because you can't really, you can't get blood from a stone. Like getting money from them when they're not paying rent, you're not getting money for those renovations. So you're kind of, again, you're out of pocket as an individual that you're probably, like I did, had to go pull out debt to do that. And you're frustrated with it. And so you're not interested in getting back into it. Do I, have I gotten back into the rental market since? Yes. It took a number of years, but I was not interested on that property of going through that once again. And that property was, again, effectively removed from the rental market because of the process for eviction and all that. So, just really, if it had been a quicker process through the landlord and tenant board of kind of being, if you look at the US of like a 30-day, 45-day process, then it might have stayed, because it wouldn't have lasted for so long, where then the property is treated in disrepair over that period. You can kind of get in and clean it up quickly to get it back rented out. But in this case, took months upon months.
Yeah, I'd be interested to see. I don't think this stat exists. It might, but I don't know how accurate it could be. But I'd be interested to see what percentage of investors own multiple properties. So like how many ma and pa kind of like own their primary, own a rental, versus people that own multiple rentals, even if it's just two or more,
Mm-hmm.
And the reason I say that is because in that example, in your example that you just gave, that's a perfect scenario where someone could be, they own their primary, they own a rental, and their primary is paid on time, they have a good job, their credit's great, and then you get a tenant that's a bad actor, doesn't pay their rent for 6 months, destroys the property, and now you potentially, as the landlord, could be going into arrears on the mortgage because of something that is kind of outside of your control.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free, unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
A little segue here. We have actually seen the Canadian banks see record mortgage contraction as arrears rise. So the CBA, which is the Canadian Bankers Association data, shows that at Canada's largest banks, the mortgage arrears rate rose to about 0.24% in August. That's the highest since September of 2020. More striking, total mortgage volumes held by banks are contracting, a rare situation historically. This article argues the combination, I'll show you the article in a second, signals a shift from household stress to broader liquidity, market risk in the housing and mortgage sector.
Yeah, I think the contraction of mortgage volume, it being a rare situation historically, I think a lot of that has to do with the rising rate environment. People aren't really as apt to refinancing to consolidate debt. They want to kind of maintain that same repayment period or loan amount and repayment period. But I think you have it later on, but it's showing up in unsecured debt instead.
Yeah, exactly. So this is actually this first chart here shows the mortgage arrears rate. So you can see, I wouldn't say it's at all concerning, but if you look at, from September of 2022 till now, like it's a pretty aggressive upwards curve on the percentages. Now we're still talking 0.1 to 0.2 to 0.3. So these aren't exactly like massive, but when you're talking about a national scale of mortgage arrears, going up 0.1% is pretty significant, This other chart is interesting as well. It shows total residential mortgages at CBA member banks. So this just shows, basically total amount of mortgages has decreased from kind of the peak in June 2022 to now. At that point, it was 5.11. That's in millions, so 5.11 million. That's number of residential mortgages, and now we're down to 4.94. So it says one of the more unusual signals in the CBA data is a steady decline in total mortgages. So member banks held 4.94 million mortgages in August, down 1.7% from a year ago. This isn't a blip, but mortgage counts peaked at 5.12 million in June and have since fallen 3.5%, marking the lowest level since October of 2020. Year-over-year growth has remained negative since April of 2023, the first sustained contraction since records began in 1995. Something else I wanted to show here is this chart, which actually breaks down delinquency rates being lower for non-mortgage holders. So you can see on the left side, there's three charts for each. So automobile, line of credit, credit card. So it shows mortgage holders on the left and their percentages of delinquency versus consumers without a mortgage on the right, which you can see in most cases, it's almost, I'd say 4 to 4 times higher for consumers without a mortgage. So when I originally looked at this, I actually thought it was the other way around, thinking that this was actually going to push up more mortgage delinquencies because they were carrying more debt, but it's actually the opposite, saying that mortgage holders actually carry less debt, obviously because the majority of their debt is probably in that mortgage. So consumers without a mortgage are higher. So anyone listening, come check this out. I don't want to go through each individual column, but you can see it's a pretty surprising, I guess not surprising number, but when you look at the chart, like the numbers are fairly staggering as far as how much more debt and delinquency, not even debt, but the actual delinquency rate of people without that mortgage. And, we know this just from being in industry for a long time that people pay their mortgage first. I mean, that's just what they do. I mean, that's like, you put the roof over the heads. Same thing. If you don't have a mortgage, you pay your rent first and then everything else kind of comes secondary. I think in this case, and I mean, we see it all the time. I've dealt with more clients recently that have delinquency issues that are looking to restructure, kind of pay off some debts. They've kind of been coming out of that, 1.8% rate environment and have been kind of spinning their wheels for a few years and are now trying to get back ahead of it, right? By reamortizing or restructuring that mortgage or paying off some of those outside debts or so on. So a lot of I shouldn't say a lot, but I've seen multiple clients recently that have 4 or 5 different credit products, whether it be credit card, line of credit, et cetera, that are fully maxed out, right? And we're just using the equity to kind of consolidate all of that, pay all those debts off, get them back to zero, so they just have that one monthly payment and can get back ahead of everything because people have kind of been, they got used to that 2% environment, that low mortgage payment, and started kind of living outside their means. And now, the bank always comes calling, right? They're not going to let you just have that money. They want it back eventually. And now is kind of that time where they, clients have the opportunity to get ahead of it again. But it's, we oftentimes have to talk to clients about like behaviors as well and kind of living within their means. And even in those pre-approval conversations, explaining to clients that, you're pre-approved for 800. I talked about this last week, but just because you're pre-approved for 800 doesn't mean you have to buy an $800,000 home with that $3,200 a month mortgage payment. Like, buy a $700,000 home, make it $2,500 a month, and you just essentially saved $700 a month, in your debt obligation. Just kind of understanding that overall picture, understanding yourself, like what is our total income as a household? What do we have to allocate for each individual item, whether it be housing, food, memberships, kids sports, et cetera, and just making sure that everything is lined up and dialed in and that there's nothing just being kind of thrown away or disregarded or that you're spending outside of your means. And you usually know when it's happening, right? It's like, oh, well, we can't really afford this trip, but let's do it anyways. You know what I mean? Like you kind of know that you're stepping over that line and that's when it can bite you down the road.
I think it's, to that point and that graph that you showed of delinquencies amongst mortgage holders and non-mortgage holders, the renters, the non-mortgage holders, which would be, renters or live with parents, by and large, all the different types of debt are between 7.5 and 9.5 times higher for renters than mortgage holders. As far as those delinquencies, which is a staggering figure. It's important for renters to recognize that if you have a goal in the future of purchasing a home, this is exactly the type of thing that will sewer you on that mortgage opportunity And whether it's even 5 years down the road, you're going to have issues if you're defaulting on consumer products, car loans. They're looking at your, if you're looking at like a Borrowell or something like that, where you're looking at your credit score, it's looking at a 12-month history. It's not a proper representation of what the banks look at for your credit history. They're looking at your entire life ever since you first got a credit card at the age of 18, if you did. And they take that all into consideration, your OSAP loan, your student line of credit, your credit card, your car payments, etc. So defaulting on those types of debt is going to sewer you and make it that much harder to borrow in the future, or push you into the alternative space, or increase your requirement for down payment and not be able to get away with that lower down payment. So, the number in that of being 7 to 9.5 times higher than the people with mortgages. I get exactly what you said, though, that the people with mortgages have equity in some cases, that they're able to consolidate that debt. And so before they get to that delinquency period, they're consolidating it into the mortgage. And so they have that ability and flexibility, whereas renters don't. But I think it's imperative for renters to understand, and if you are a prospective buyer listening, like, their banks are looking at your entire credit history. So, really keep that in mind as you're thinking about, buying in the future.
Yeah, and they hold the money, right? So, I mean, we had a situation this week where lenders looked at a client's bank statements, didn't like what they saw, and decided to walk away. Now, did they give us specifics on that? No. They don't tell us why, but everything you do financially, every decision you make, everything you're spending money on, like, they're analyzing it, and it speaks to your overall profile and your, eligibility as an applicant to that lender. Like, if you're lending someone hundreds of thousands of dollars, you want to know what their behaviors are, what their credit history is, how likely they are to repay you that $400,000 or $500,000, right?
What their spending habits are.
Exactly. Yeah.
On a regular basis, they definitely come into play. One analogy I heard many years ago was looking at it from the lens of, would you lend this person, or would you lend yourself $500,000? Kind of looking at it of your, like, someone's own, like, spending habits, and not being biased to, like, how someone's, being like, oh, well, I would lend myself that money. Like, looking at, your own view, or if you're talking about somebody else, like, okay, well, yeah, you know what they do for a living, or how they spend money, or that or you could see their credit. Would you lend them $500,000 of your own money at 3.5% return? And if you're not willing to, again, why should the bank?
I want to end with a quick listener question, Dave, and we can probably answer this one pretty quickly, and we deal this all the time, so fairly relevant. It says, with fixed rates jumping around lately, how do I know if I should wait for the next potential drop or lock something in now before rates climb again? Clearly this person listens, because we say 1 week rates are going down, the next week rates are going up. So they know.
Yeah, no, it is a very good question. And obviously that person is a variable rate holder, looking at and debating whether to lock into a fixed rate or not. Some of it is personal preference, that worry or concern about where the economy's heading, paying attention to the Bank of Canada. Is it going to drop? Is it going to increase? Is it going to stay stagnant? Kind of looking at that, and then versus locking in on a fixed. There was some economic literature out recently that, and historically we've seen the fixed rates kind of come down and kind of average around the mid 3s for a 5-year fixed. We're above that. Is there room for it to drop? I think kind of in that mid 3s range. Right now, I was reading this morning, some stats that the projected savings between fixed and variable over the next 5 years, with where they're at now, where the market has priced in for them to go, is that there is about $1,000 difference between them, of kind of maintaining on that variable versus like a fixed. So some of it comes down to your personal preference, like watching the market. What are you planning on doing with that property? Because penalties are also minimized with a variable rate mortgage to only 3 months interest versus a fixed where you have an IRD. So looking at that as well. Are you in an adjustable rate mortgage that fluctuates, or are you on a static variable? So it's, it is a short question, but there are a lot of components to it. So I would just say there's a lot of factors to look at. It would be best for you to speak to a professional that can kind of look at and dive into what your personal situation is.
Give us a call, is what Dave's saying. Should we slide in some mood boost, David? Thank you for answering that
Let's do it.
Listener question. And anyone listening, if you have questions, throw them on our YouTube channel, put them on Instagram, put them wherever, put them on our socials.
Email,
and we'll
whatever.
What was that?
I said email us, whatever.
Email us. All right, I got 3 today. Here we go. Number 1. Have you heard about the new broom? It's sweeping the nation. Sweeping the nation. Number 2, to the guy who invented the zero. Thanks for nothing.
Okay.
Thanks for nothing. And number 3, I tried to catch some fog yesterday. I missed.
Clever.
I missed.
That's clever.
The old gas joke. Thank everyone for tuning in. We like being here. We enjoy this. Episode 240, David. Quick shout out as well to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP, and you get 20% off each and every order. That's it. That's all we got today, Dave.
Swell.
Be sure to check out our socials. Thank you, everyone, for listening. We love you. We'll be back.
Deuces.
Bye.